Oh, that's real good.
Hello everyone, and welcome to our channel Penny Lesson. We talk about everything finance, from tips on making money and proper investing to news about the different economies and situations affecting the global markets. The goal of this channel is not only to teach you how to be more financially responsible but also to teach you how to be more aware of global events. So why not just sit back and relax while we tell you what's happening in the finance sphere? Be sure to subscribe to my channel and hit the notification bell to be constantly updated on my latest videos. Remember, one penny lesson a day keeps being penny less away. For those who are brave enough to try, I've always thought sidestepping some pain might be a good idea. They are mentally easy but psychologically hard. Extremes are usually easy to spot. 1928 to 1929 was a massive rally. Price hikes are apparent. Second, great bubbles always rise faster at the end to make it easier. All three were accompanied by massive public behavior. Same in 1929. Likewise for Japan. We had a group from Salomon Brothers, a leading American brokerage house, in 1988 to 1989 when Japan was moving to 60 times earnings. They should have sold 100 times and were cheap. Buy them. And the Japanese market broke the following year. It hasn't recovered its 1987 peak. This taught us a lot about human behavior. This also explained why big companies couldn't play. It is not a commercial proposition to get out of a bull market because they run further and faster than expected. Japan exceeded people's expectations. The previous record was 21 times earnings, so 35 times is much higher. Sometimes they're extreme. It changes nothing, so that's bad. Arriving changes everything. If you have a bubble, focus on it. U.S. growth stocks in 2000. It wasn't global, and the land was affordable. Inflation-protected bonds were affordable and yielded 4%. The actual yield is inflation-proof. Even within the market, value stocks were not too bad, small stocks were not too bad, and small value was cheap enough that when the SP went down 50, it hadn't gone down. The REITs were up 30%, while the SP was down 50%. It was a bubble, but an asset allocator had many options. Japan's 1989 mistakes should be avoided. The Japan bubble was the biggest ever. Land under the Emperor's Palace was worth more than all of California. It's a big palace with fantastic grounds in downtown Tokyo. Overall, it sold for 4 to 6 times downtown Manhattan. The numbers are significant. At the same time, they had a giant stock bubble. Tiny markets don't count, but it's a massive bubble in any vital market. At the time, 65 times earnings were reported. But at the time, everyone agreed 65 times earnings were remarkable and had never sold at over 25 times. This is what keeps Japanese stock value managers up at night. They did both at once 31 years later, and it's still gone. In the last decade, they inched forward. They didn't go backward for 10 years. Such a loss of wealth spells trouble. Now in a financial crash. The housing market's 3 sigma, a once-in-100-year bubble, had been historically stable. It only needed to go up 40 or 2 to 3 years to get there, which it did. Then 2007's housing bubble took the stock market down with it. The stock market was a big overpriced bull market. It wasn't a bubble, but housing was a beautiful, perfect bubble. It goes up and down at the same rate for 3 years. Back to where it came from. The housing bubble lost $10 trillion worth. Then you thought it was worth $400,000. 3 years later, it was $550,000. 3 years later, it was $400,000. Then 2 years later, $350,000. You lost a huge asset, and housing markets are riskier because more people own them. We have 4 main asset classes. There's 3.5 left. We have the most overpriced bond market and the lowest rates in 4,000 years, says Jim Grant. There is no time when paying the government to take your money had a negative return. 1. We're competing for the most expensive U.S. stock market in history. Most bubble experts think it's higher than 2,000, but we can agree it's a contender. Then real estate was off screen until a few minutes ago, and it's risen 20% in the last year. The Schiller series lags, but the other series, up 20%, is sharpest. Multiple family incomes are our hero metric. How much does the median house cost, and how many multiples of the median family income? It's a fair, stable metric. America used to sell it for 3 times family income. In the bubble, we went back to 4.5. We are at the exact multiple of family income as in 2006, at the housing bubble's peak. Back. Rates are low. In theory, you can afford it. You can't buy it as a beginner. These are great for retirees with nothing to do but liquidate assets. For those without it in society, it's a disaster because asset yields have fallen as prices rise. People without assets are doomed. The whole community is compounding slowly. So here we are. We have all three. First time in American history. The real estate, bond, and stock markets are all on the rails. The Goldman Sachs non-energy index is absurdly high. When they break out oil and non-oil from the total index, you can't tell the difference from the energy part. If you look at the non-energy part, which includes metals, foods, and cotton, it's back to 2011's all-time high. It's commodities' big move again. Who knew a broad base of commodities, many of which count, are back to all-time highs, and the UN Global Index of Food Prices is close to the 2011 high. The energy story is more complicated because fossil fuels are ending. I suppose the paradox or irony is in the US stock market. Even though developed nations are overpriced, it's fair. It's hard to find anything alike. In the last 20 years, the market's price-earnings ratio has been 70% higher than in the previous century. Not a small amount, is not 15%. In the last 20 years, US profit margins have risen 30%. You've changed a lot. Corporate management 30 years ago focused on expansion. When the paper market got tired, they would open new mills. Now they focus on profit margins and buy back stock with their extra money. It works well for corporate officers, pushes up the stock price, and is bad for GDP growth and jobs, but it's good for the corporation and stockholders. No easy correlation between a good economy and stuff. If you read or listen to the news, you may think so, but there's none. If you correlate prosperous countries, you can't find one. Rapidly growing countries tend to underperform. Countries that grew slowly tend to do better in the market. Return is driven by profitability, not growth. I'm causing a lot of trouble among my fellow value managers by saying I don't think this market is a bubble, but I still wouldn't invest in the US market. I think emerging markets were cheap compared to the US. In 2008, it sold at a premium price to earnings ratio, but by last spring, it was cheaper than after the 2009 crash. The US, priced at 11 times earnings, went to 22, and emerging went from 11 times to 10. Divergence in favor of the US is a good sign. China and India have outgrown everyone else, which is a strong economy. What should scare us is the Chinese success in educating their workforce. MUT scores are higher than in the US. They are cheaper and better at basic quantitative methods. We should be worried. I'm tense. I think capitalism does more than other top-down economic systems. If it's very long-term, capitalism isn't suited to it, and the Chinese can handle them better. Science is respected more. The most significant risk to American business and society is the drift toward more corporate power in politics and through monopolies and less for workers, the destruction of unions, and income inequality, where we rank 20th out of 20 wealthy countries. We're unequal. How fast you can move up the economic ladder. One used to think of America as highly mobile, where it was the hardest in the developed 20 countries to go from the lower to middle classes. Long term, this threatens a capitalist society's vitality. Imagine you fired every worker. Since 1970, hourly pay hasn't risen with inflation. Since 1970, the average U.S. hourly wage hasn't changed. It's when people from one industry run a regulatory body meant to protect the public from misbehavior. The company has them. A good society has waves. You move toward capitalism and the worker. Wow, was that news? Why not ponder it? Want to know the latest? Comment if you want more articles like this. This video is just one of many videos on my channel that brings you the latest news about the world of global finance and economics. So go hit that subscribe button if you don't miss out on content like these. If you enjoyed this video, please hit the like button. Thank you for all your support, and I'll see you again next time. Remember, one penny lesson a day keeps being penny less away. Cheers.